joining us for a look at the day's markets activity is Viv Govender from Rand Swiss Offshore. Viv, lovely having you on. Happy New Year. Now let's get things started. As I said, global markets kicked off the week on the back foot with most stocks trading in the red. Viv, is this mainly on the back of those fading rate cut hopes? I mean, it's general consensus that we will start seeing rate cuts this year, but is it too soon to say that we'll be seeing them by March?
Yeah, I think it's always too soon to say we'll be seeing them by March. I mean, especially the kind of confidence that has been given out by the market. At the moment, yes, we are seeing U.S. inflation come down quite dramatically, and global inflation overall coming down quite dramatically. Helped by things like lower oil prices, some easing concerns around the Russia-Ukraine conflict, etc. But there's still upside issues. I mean, there's, for instance, what's happening with the Red Sea right now with the Houthis. It adds in some measures up to 40% in travel times from Singapore to Europe. And we look at the amount of stuff that travels from those two places, especially not just in terms of just normal consumer trade, but in terms of things like that are used for manufacturing, etc. It really disrupts supply chain. So there's upside risks still in the world. And for us to assume, as we were assuming just a couple of weeks ago, that there's almost a certainty of a couple of rate cuts before the middle of the year, I think was a bit too optimistic.
I mean, I've always said that I feel like global traders are kind of getting ahead of themselves when it comes to the trajectory of rate cuts. Is it just trying to look for some signs of positivity within the markets?
Well, look, I mean, also remember most people that are investing at the moment, started doing that, post the last 20 years or so. So if you started when you're 25, like back in 2000, now you're almost 50. And if you're looking at a situation in which, your entire career, you've expected rates to be, coming down all the time, it's been a good bet for you. And I think that's one of the things feeding into the psychology here. If you look back 2 years ago, what the expectations were for rate cuts, we would have had a couple of rate cuts by now. Forget about in, about 3 months or 6 months time. They were expecting rate cuts, at the start of 2022 by the second half of 2023, which obviously were not happening. In fact, we're looking at rate hikes at that point in time. The market has been, trending towards being more optimistic about cuts than I think the data has been, willing to back up.
Speaking about data, we had key data coming out that moved markets last week. On Friday, U.S. non-farm payrolls report for December was out. That data came in above expectations at 216,000 versus that 170,000 that was estimated. But that labor market is still proving to be quite resilient.
Oh, yeah. I mean, every number there was better than expected. Their unemployment rate was better than expected by about 0.1%. I think they also saw wage growth being slightly higher than expected as well. And the thing with the Fed is that you must understand that the reason that we have rate hikes is the way it works is it basically slows down growth by making things more difficult to do. You want to see high unemployment. You want to see people more desperate for jobs and therefore not asking for high wages. That's literally the mechanism it works through. And the fact that we're seeing the labor market as strong as it is, we're seeing wages still as strong as they are, even though inflation is coming down, is not something the Fed wants to be seeing.
I mean, there is some positivity in the market, but geopolitical risks are still dominating headlines, especially tensions that have been playing out in the Middle East. Now, keeping that in mind, we saw Saudi Arabia-led oil price cuts and a rise in OPEC's output. Just talk to us about those moves and how they influence the oil market.
Yeah, look, OPEC is going through a bit of a change at the moment. So Angola has exited because they wanted to be improving production at a point at which cuts were coming through. When you have a cartel like this, there's always the incentive to cheat. What you do is you let the cartel members do the heavy work and cut production, and you take the benefit without doing anything else by just basically producing as much as you want to and just using the higher oil prices to basically make more money. So everyone has an incentive to cheat. The fact that Angola is exiting is a real challenge, I think, to OPEC, and they need to figure out some way to, firstly punish a country like Angola that leaves, and doesn't. You need to make it so that it's not easier to be outside OPEC than to be inside. Number one, and the second thing is to basically try and maintain unity in terms of, right now kind of a weak global economy. Yes, we are seeing, these moves in terms of cuts and stuff coming through over the last little while, but they have not really had an impact in terms of pricing. That's something that what OPEC has been hoping for. And oil prices, as where they are right now, I think are significantly lower than OPEC wants them to be, despite the actions they've been taking. So they have a number of challenges. I think one of the big ones is things like, for instance, Angola leaving, which could be fatal for OPEC if they seem to be doing well without them.
Now, Viv, I just want us to come back at home. There's hardly been any company news, but there was a sense from Life Healthcare, just updating the market on the progress of its disposal of that UK Business Alliance group. What have you made of this move, especially at a time where we have the progress of the NHI bill? Is a move such as disposing of your international brands is it the right time, rather, to dispose of such brands, especially at this precarious time within South Africa?
Yeah, look, I mean, we got, I think it was 21 billion or something for their stake, which is obviously a nice little, operation there. But I do think that, you are correct. It does increase the risk because, of course, the things like the NHI coming through would make the South African business much more vulnerable to a downturn than a business that has South African and international sources of revenue. That being said, the NHI has been discussed for a while. Yes, there is progress happening in Parliament at the moment, but I mean, most people I've spoken to in the healthcare industry seems to think it's unworkable, and hopefully, saner minds prevail, and it is delayed until they find a reasonable way to make this go. Pushing it through at the current, form, basically, I think would be disastrous, not just for the healthcare companies out there, but for South Africa as a whole, because it could easily do long-term damage to our healthcare system.
Now, before I get your stock pick, let's just reflect on some on what some of your peers have picked last year.
Sort of in that sphere, in other words, in the texture and possibly an alternative to something like now special process, and that's Bytes Technology, which was the in the UK supplies Europe with hardware and software services, including cloud services, artificial intelligence, support, that kind of thing. So based in the UK, supplying the UK and Europe. Great return on equity, very conservative dividend policy. Now, but enough free cash flow to cover that. It's just gone to new highs, both in the UK and locally, which is also the kind of momentum I like as far as the share price is concerned. I don't think they're specifically cheap, but considering the industry they are in and the limited choice a local investor has when it comes to the tech sector, it seems like an obvious choice.
So Bytes Technology, is that one that piques your interest, Viv?
Yeah, look, I mean, the company has done reasonably well. You look at, for instance, you're seeing double-digit growth in terms of profitability here. And in the last year, it's done, quite well. I mean, we're talking about a 65% effectively increase in the share price. It's come down a little bit, in the last couple of weeks, but that's something that one would expect after seeing such huge upward movements. So I do think that in terms of just the performance of the stock, it's been good. I'm just a bit nervous, as you'll see my stock pick, because some of these tech companies have really rallied in the last year or so, whether or not some of this performance has been maybe a bit overdone.
So Bytes not something you are dipping into. What is your stock pick?
Well, I think at this point in time, I think it's smart to look for something like a hedge trade. It's a very uncertain economy out there. It's a very uncertain world. We're having rate hikes. We're having elections, I think, affecting 40% of the world's population. This could be a very interesting year, 2024. In such a situation, a hedge trade is obviously, better because it gives you that long and short. I would go long the S&P 500 and short the Magnificent Seven. If you look over the last year, the Magnificent Seven companies like Apple, Microsoft, Alphabet, it was Meta, Facebook. Those guys have, really outperformed the market and, were responsible for the bulk of the improvement in the share prices of the S&P 500. A lot of the stuff is based on, I think, hype around some of the new technologies coming out there and may in some cases be overdone. And I think if you're looking at, a safer trade this year, you'd go probably long the overall market, the S&P 500, and short, these big 7 companies.
Thanks, Viv. Thanks for your insights as well as your time today. That was Viv Govender from Rand Swiss Offshore.